What is the earning credit rate? The earning credit rate, ECR, represents the daily interest paid by banks on customer deposits. It is calculated based on the account balance in non-interest yielding accounts, with the amount derived from the ECR used to offset service fees. Consequently, customers with larger deposits enjoy lower banking service charges. Financial institutions often align the ECR with the rate of the US Treasury bill, typically pegging it to the 91-day Treasury bill rate. The primary purpose of the ECR is to mitigate fees associated with various banking services, including credit cards, debit cards, business loans, savings accounts, and merchant services. This mechanism benefits both banks and depositors by encouraging customers to maintain substantial balances, thereby allowing them to save on banking fees. For customers who consistently hold balances above a specified reserve, the ECR effectively reduces costs related to draft fees, debit card fees, and loan processing fees. The origins of the ECR trace back to the 1930s during the Great Depression, when the U.S. government implemented banking regulations under the Glass-Steagall Act, restricting banks from providing interest on commercial demand deposit accounts. The aim was to discourage commercial deposits in banks, prompting businesses to seek alternative investment opportunities. By the 1960s, U.S. banks began offering credits on non-interest yielding deposits as a way to balance banking service charges, enhancing the value provided to customers and incentivizing them to utilize more banking services. The ECR features several characteristics. Unlike hard interest, which is taxable, the earning credit itself is not taxable. Customers often utilize their account balances to meet short-term financial needs, offsetting service fees in the process. Generally, hard interest rates exceed the ECR. Notably, bank service fees offset by the ECR are not deductible, whereas unoffset fees can be claimed on tax returns. The advantages of the ECR include efficiency, as the application is automated and does not require manual execution, saving time and resources. It aids in cost control by reducing service fees, thereby enhancing operating margins and shareholder value. Additionally, the ECR facilitates liquidity management, allowing businesses easier access to funds and aiding in cash flow forecasting. Transparency is another benefit, as banks provide detailed account information, including balances and transaction details, accessible at any time. However, there are drawbacks to the ECR. Its applicability is limited to collected balances, not ledger or floating balances, meaning only cleared funds count towards the ECR calculation. There is also a significant variation in ECR rates offered to corporate clients, even for similar balances. Furthermore, different banking strategies among regional banks and money center banks can result in disparate credit rates, with larger regional banks typically offering higher rates compared to the largest U.S. banks. Looking ahead, the ECR is evolving alongside banking innovations to meet changing customer demands and market pressures. This concept has gained acceptance and is being adopted by various governments globally, with potential for expansion to offer benefits regardless of geographic location, helping customers generate greater returns from their worldwide balances.